Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss one question where we are required to calculate ratios for two different years of same organization, compare them and how to comment on them. Following are the balance sheet of X Limited as on 31st March 2013 and 31st March 2014. They have given balance sheet for two different years. Particulars, let us mark this for vertical arrangement. Share capital, it will be part of shareholders fund, share capital. Retained earnings means reserves and surplus. It will be part of shareholders fund. Provision for income tax, this is current liabilities and provisions. Debentures, so secured loan, borrowed fund. Accounts payable, this is trade creditors and bills payable, current liabilities. Other current liabilities. Assets, building and equipments, this will be part of fixed asset. Land, fixed asset. Patents, fixed asset. Account receivables, this is bills receivables and debtors, current assets. Inventories, current asset. Prepaid expenses, current asset. Cash, current asset. Calculate the following ratios for 2 years after preparing vertical format statement and make comparison. Debt equity ratio, quick ratio, stock to working capital ratio, proprietary ratio. Let us prepare a vertical balance sheet first. We have prepared in a common format where 2 years are included in same format. So one is particular column and one column for balance sheet as on 31st March 2013, another column for balance sheet as on 31st March 2014. We have kept two sub columns. First part is sources of funds. Here first item we have shareholders fund. In shareholders fund, first item we have share capital. Share capital as on 31st March 2013, 4,50,000, and as on 31st March 2014, 6,60,000. To this we are going to add reserves and surplus. Here they have said retained earnings 2,31,000 and 2 lakhs. We can add these two to arrive at shareholders fund 6,81,000 and 8,60,000. Next we have borrowed fund. In borrowed funds, we have debentures, that is a single item, 2,20,000 and 1,80,000. We can add shareholders fund and borrowed fund to arrive at total capital employed. So total funds employed as on 31st March 2013, 9,01,000. As on 31st March 2014, 10,40,000. We have completed first part of the balance sheet. Now next part is application of funds. In application of funds, first item we have fixed assets. We have here fixed asset, building and equipments, land, patents. These are the three fixed assets we have. Building and equipments, land and patents. We can add them to get total fixed assets. Five lakh 85,000 and 6,45,000. Next comes long-term investments. In this question, there are no long-term investments, so we are putting dash over here. So next item we are required to consider working capital. In working capital, first we are required to consider current assets. We have current assets, account receivables, inventories, prepaid expenses, and cash. We can add current assets 4,79,000, 4,92,000. Now from current asset we are required to deduct current liabilities. In current liabilities we have provision for tax, accounts payable, and other current liabilities. Provision for income tax 84,000. In second year there is no provision for income tax. Accounts payable 58,000, 64,000. Other current liabilities 21,000 and 33,000. Let us add current liabilities 1,63,000 and 97,000. From current asset we'll have to deduct current liabilities. Net working capital we got 3,16,000 and 3,95,000. This amount will be adding to the amount of fixed assets. Fixed asset 5,85,000 and 6,45,000. Thereby we'll get the amount of total assets. Total assets 9,01,000 and 10,40,000. Total of first part of balance sheet is also 9,01,000 and 10,40,000. So we have completed vertical arrangement of balance sheet. Let us proceed to calculate relevant ratios. Let us calculate ratios. First we have debt equity ratio. Formula is borrowed fund divided by proprietor's fund. Proprietor's fund means shareholders fund, where we have values 6,81,000 and 8,60,000. Borrowed fund means here debentures 2,20,000 and 1,80,000. For 31st March 2013, debt equity ratio we got 0.32:1. For 31st March 2014, debt equity ratio is 0.21:1. Next we have quick ratio. We'll calculate current ratio as well as quick ratio. Formula for current ratio is current asset upon current liabilities. Our current assets were 4,79,000. Second year 4,92,000. Current liabilities 1,63,000 and 97,000. Current ratio for first year is 2.94:1 and for the second year 5.07:1. Quick ratio quick assets upon quick liabilities. Out of current assets, inventories and prepaid expenses are not quick assets. So from total current asset, we are required to subtract them to arrive at quick assets. Out of current liability, provision for tax, accounts payable and other current liabilities, all are current liabilities. Formula for quick ratio we can put like current asset minus stock minus prepaid expenses divided by current liabilities minus overdraft minus income received in advance. So for first year we are getting quick ratio 1.06:1. Here all current liabilities are quick liabilities because there is no overdraft and no income received in advance. For the second year it is 1.81:1. Next we have stock to working capital ratio. Formula for stock working capital ratio is closing stock divided by working capital multiplied by 100. Working capital here means current asset minus current liabilities. For first year, stock is 3 lakhs. For second year, 3,12,000. Working capital for first year 3,16,000. For second year 3,95,000. Stock working capital ratio for first year 94.94%, and for second year it is 78.99%. It can be rounded off for first year 95% and for second year 79%. Next we have proprietary ratio. Formula for proprietary ratio is proprietor's fund divided by fixed asset plus long-term investment plus current asset multiplied by 100. For first year shareholders fund, that is proprietor's fund, amount is 6,81,000. For the second year it is 8,60,000. For first year fixed assets 5,85,000, second year 6,45,000. Plus long-term investments, but in this question there are no long-term investments. Next, plus current assets 4,79,000, 4,92,000. For first year proprietary ratio is 64%. For second year 75.64%. We have calculated all the ratios which are asked in the question. Let us see the last part of comparison and comments. Debt equity ratio for first year it is 0.32:1, second year 0.21:1. It shows that this ratio is decreased. The reason behind decrease is proprietor's fund was 681, has become 8,60,000, whereas borrowed fund it was 2,20,000, it has gone down to 1,80,000. Reasons are increase in capital and repayment of loan funds. Next we have current ratio. For first year it is 2.94:1, second year it is 5.07:1, second year 5.07:1. Quick ratio 1.06:1 and 1.81:1. Quick ratio as well as current ratio both have improved. As there is improvement in current ratio as well as quick ratio, it indicates short-term solvency and liquidity position of company has improved. Next we have stock working capital ratio. The first year it is 94.94%, second year 78.99%. Standard stock working capital ratio is that it should be less than 100%. So in both the year it is less than 100%, indicating good control of management on stock. During second year, it has become 78.99%. It indicates that there is better stock management during second year. Both years ratio is good as less than 100%. Second year, better control on inventory can be seen due to improvement in ratio. Proprietary ratio, first year 64% and second year 75.64%, that is almost 76%. This ratio shows long-term solvency position. Definitely during second year, long-term solvency position has become more better because proprietor is having more share in assets. Both years ratio is good. During second year, this ratio has become more better at approximately 76%, showing strong long-term solvency position. We have calculated all required ratios for both the years. We have done comparison, that is one of the important tool of management decisions. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.